Hi, today we are going to be covering the impact of the CARES Act on your 2020 taxes. My name is Alex Perney. I will be reviewing this with you today. It's going to be a little bit of a shorter presentation today, as there is just some very pertinent end of year information that you'll need. I do encourage any questions that need to be asked to get out there. I'm certainly happy to review those and make sure everyone gets appropriate information for their specific situation that they have. But keep in mind, this is going to be a bit truncated on the normal hour that we run. My name is Alex Perney. I am a development specialist here with Advanta IRA. I've been with Advanta since 2012, so I've seen a lot of different tax law changes over several different administrations. So if you have any specific questions on IRAs or how the retirement plans work in general with any type of taxation, please feel free to ask me any of those questions. My direct contact information is up there for anyone that is just listening without video. My direct line is 727-754-9954, and my email is aperny@advantaira.com. So we're going to be getting into a lot of specifics with regards to tax filings and things that are going to have taxable implications for you as the taxpayer. So before we get started, I just want to make sure that everyone understands Advanta IRA and our employees, we do not provide investment or tax advice, nor do we endorse or promote any investment products. All information and materials are provided for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment or taxable or situation that's going to have taxable implications for you personally. So the few key points I want people to take away from today are the IRA distribution updates, your rollover rules that have changed, and your end of year issues that have come up. These are going to be the three main things. And keep in mind that when I say end of year, we're referring to the end of the year as of 12/31. So that's really going to be the last day of the year for the purposes of being able to change anything or have anything maybe not count, or the date that is going to be set for anything that you need to do as far as a deadline for things that are going to be counted on your 2020 tax bill. So a few things have changed with regards to the CARES Act. We had things like required minimum distributions being waived this year, although it was waived a little bit later on than when people initially started taking them, so people maybe had rolled them back in. As of right now, the required minimum distribution payments are slated to resume in 2021. So if you are over the age of 72 and you have a required minimum distribution, those are slated to be back on the table in 2021. Now, we haven't necessarily seen anything with regards to either of the competing bills from the Democratic legislatures or the Republican legislatures that would show that this is really a big part of any meaningful legislation that's coming out with regard to updated coronavirus relief. So required minimum distribution payments are slated to resume in 2021 for anyone anyone that is 72 or older. Now, you still do have the ability, if it's your first year of reaching the age of requirement for required minimum distributions, to defer a required minimum distribution. So maybe for whatever reason you have a less than favorable tax situation coming into 2021, if you are reaching the age of 72 within the year of January 1 to December 31 of 2021, you do have the ability to defer that required minimum distribution payment into the following year. Just keep in mind, in the year of 2022, you will have to take 2 required minimum distribution payments. Also keep in mind that failure to take a required minimum distribution payment, unless it has been waived by Congress, is half of the required minimum distribution amount. So it's definitely in your best interest, especially if you are older, to keep a very close watch on exactly what is coming about with regards to your 2021 required minimum distribution payments. Now, the $100,000 participant loans are an augmentation of the original legislation of being able to take up to $50,000 or half of your vested balance from a 401k as a loan. Now, what the CARES Act did is it allowed for plan providers, so employers that are providing a 401k plan, to augment their adoption agreements to allow participants to take up to $100,000 as a loan from that 401k. Now that can still be done up until 12/31, but those numbers are slated to go back down to 50 in the taxable year of 2021. So if you want to take advantage of that and you want to be able to take a loan out of your 401k, you need to do that by 12/31. It's also a good idea to make sure that you understand that you need to ask your employer if they actually allow for this, because not all employers augmented their plan documents to allow for the updated increases. They weren't necessarily required to do so. So if that's something that you've been thinking about, now is the time to contact your employer to see if they have augmented their plan and to get that process started. Also, if you would like to defer your first year of payments, that election has to be made by the end of the year as well. So you'll need to make sure you do all of those things. If you want to defer that first year of payments on that 5-year loan from the 401k and take out up to $100,000 participant loan, you need to make sure you start that process now, because those things are slated to change and go back to January 1st. Now, this is also separate from the penalty-free distributions from other types of retirement plans, namely IRAs. So with an IRA, you were able to take out a penalty-free distribution from the IRA if you had qualifying impacts from coronavirus, and you had up to 3 years to repay those funds back as a rollover into that plan. Now, if you would like to take a distribution from an IRA, you need to make sure that you are doing that by 12/31, because any distributions made into next year, the 3-year repayment window is not currently slated to cover that. So if you'd like to be able to roll those funds back into the plan, but you would like to use it for personal needs and do want to roll them in over the next 3 years, you need to make sure you take those funds out before January 1st. Otherwise, you might not be able to, because as of anything that I've currently read, that's maybe not necessarily something that is going to be in any new relief bills. Now, also contributions were changed within this taxable year as well. They are slated to go back into next year. Now, currently you can't make a contribution for 2021, but it is most likely going to be normal tax filing dates next year. We did have our tax filing dates for the year of 2020 changed to come from April into July. Now that also changed people's ability to make contributions for a previous year IRA and also HSAs much later into the year, but currently we're looking like we're going to have a normal timely filing deadline of April 15th. So if you're looking to make a contribution for a plan, I would hedge on that being done in April as opposed to being done at a later date, although that can change. But it is something to keep in mind that as of the first of the year, when you can make those contributions, you are probably not going to have until much later in the year to make those. And going back to an earlier point, 401k plan document revisions were not done by all employers. So if you wanted to take out that participant loan from the 401k of $100,000 or half of your vested balance, you need to make sure that you have that conversation now, because otherwise, after the first of the year, the amounts are going to change. Presently, they are slated to change back down to only 50,000. So if you needed to take that, it is a good idea to start looking at asking and requesting for your ability to do that. Now, we do have some pressing matters that are coming up, especially for individuals that are invested with self-directed IRAs, which are what we do here at Advanta, especially things that are invested in real estate. So what the CARES Act did, it also placed moratoriums on evictions of people from homes. Now, the CDC also had a restriction or a moratorium on being able to evict renters. However, that has already expired. But as of 12/31, the restriction on being able to evict people for non-payment of mortgages is going to expire, and that is going to come back into effect. Now, this is something that I've seen tossed around that might get written into one of the new COVID relief bills, but we're going to need to wait and see. So if you do have property and you do have non-payment of either rentals or mortgage payments, keep in mind that some of those restrictions are already lifted, or they might be being lifted as of 12/31. Also, individuals that are utilizing the Family First COVID Response Act sick leave, that is going to expire on 12/31 as well. So maybe if you have tenants or if you have mortgagors that are paying that are utilizing their sick leave that act for additional payment of sick leave, it might be a good time to contact those people and try to work out something with regard to payment to make sure that you don't run into any issues with things like having to evict someone or things like that. So just it's even though it may not necessarily affect you, understanding that those provisions do expire as of 1/1/2021 is very important for you. Now, 401k plan distribution, so the $100,000 you can potentially take from a 401k as a participant loan, and IRA distributions, if you're going to be rolling those back in over several years or 1 year, they can be done concurrently, but only until 12/31. So you can take out that participant loan and also take out funds from your IRA, but you only have until 12/31 to do that. Again, presently, but it's something that you're going to want to be able to make sure that you are doing by that time, because once we get into the first of next year, if you take a distribution from an IRA, presently the rules are going to go back to you have 60 days to roll that back into an IRA, or you're going to have to pay taxes on that. And all these things are predicated on your eligibility to take the distribution or qualify for the additional relief under this act. You have to have been directly affected by either adversely financially affected by the coronavirus, or loss of employment due to the coronavirus, or an effect of one of your dependents on coronavirus. Now, this is all going to be self-certification, and I would imagine they're going to intentionally leave this relatively vague when it comes to the exact wording of the affirmations for filing your 1040s. But keep in mind that just because you want to, if you have not had necessarily any direct effect to you personally, there could be the potential for some gray area if you were to be audited and you didn't necessarily qualify. So just keep in mind that there are eligibility requirements to doing these things, especially if you're getting up to the end of the year and you'd want to utilize those funds. Now, let's say, did you take a distribution in 2020? Now, here's where things are really going to start getting different, because most people are familiar, if you've taken a distribution from an IRA and done a rollover, there's no taxes. But now we're getting into the point where these rollover rules are being extended by up to 3 years from this year. So if you took a distribution from an IRA, not only was your 10% early withdrawal excise tax penalty waived, you also have up to 3 years to roll those funds back into an IRA to not pay taxes. However, if you do leave those funds outside of the IRA after 12/31, you're going to need to claim them on this year's taxes. So when you go to file your taxes, you're going to have to do one of two things: either claim the entirety of that amount as taxable income and pay the taxes, or you're going to have to claim a portion of it and elect to pay those taxes over 3 years. Now, we have not been given the guidance as to exactly the protocols for doing that, but we do know at least that you will have to file an amended return to claw back any taxes that you have paid when you do eventually roll those funds back into a plan after you've paid the taxes on them. So keep in mind that you definitely have some things to look at, and if that doesn't sound like an appealing plan to you, rolling those funds back into the plan by 12/31 will effectively mitigate that, because the reporting that the IRA custodians do is not fluid by day to day. We report any distributions taken in a given year and any rollovers received in a given year. We'll report on Form 1099, which is a report of the entirety of a year of distributions if you took a distribution. And then on IRS Form 5498, we report an entire year of January 1 to December 31 if any rollovers have been received in that given year. So keep in mind that if you're going to roll something back in and you don't want to have to go through what is probably conservatively going to be a very bad headache for most people of having to pay those taxes and having to claw things back with amended returns, although personally, I do think there is going to be some guidance from the IRS, because this is going to be a tax filing a tax filing nightmare. That's a very easy way to say it, but it's going to be very cumbersome for people. So keep an eye out for guidance on that. But as of right now, if you have taken money out and you don't seem like you want to go through the process of having to do all these different amendments and things to your taxes, being able to roll those funds back in by 12/31 will help to alleviate that burden for you. 401k plan participant loans must be dispersed by 12/31, and you need to have your payment deferral elected by that point if you'd like to do it as well. So if you want to take advantage of the additional $50,000 of potential 401k loan amounts that you can do, have to do that by 12/31 right now. And again, the final bullet point, if you don't roll the funds back into your retirement plan, you need to elect a 1 or 3 year tax payment plan. We're going to get more guidance on that. Presently, we don't have a whole lot past just what was written into the CARES Act and some other guidance notifications that the IRS has released. I would keep an eye out for the beginning of next year in 2021 for us to get more clear guidance on filing for taxpayers for people that have taken out funds from retirement plans to help offset coronavirus expenses. So what ends on 12/31? Just to kind of circle back on everything, the federal moratorium on evictions ends 12/31. Federally issued student loan repayment starts again on 1/1/2021. So if you had federally backed student loans, those payments were in deferral for the entirety of the 3 quarters of this year. But they do restart as of 1/1/2021 unless something comes out and is signed into law before then. Those payments will have to resume. And again, 12/31 is the last day to roll funds back into a retirement plan in order to have to not claim them as taxable income for 2020. Now, I did include a few things, and some people might be kind of wondering the reasoning for that on something put out by a self-directed IRA administrator. With regard to things like student loans, eviction moratoriums, uh, paid sick leave, all these things, can definitely affect individuals' ability to pay other bills when you have other things coming in. So if you have renters or you have people that have borrowed money from your IRAs and you see that there might be some additional expenses compiling on, if you know their current situation, if they're, just kind of barely making it as it is, it's maybe something good to get out in front of. So that way you can, keep everything on an even keel, keep things on the level, and continue to have performing investments instead of, things that might cost you money or issues with those people in the future. Now, we do have some good questions, so I'll get through those right now. I'll leave my contact information up there for anyone that's interested. So David asks, my understanding is a CARES loan from my IRA would not have tax implications on 2020 if repaid prior to filing 2020 taxes. Is this not correct? No, you're absolutely correct. You don't have any taxes if you have repaid that for your 2020 tax year, but it's not necessarily repaid prior to filing because remember it's a 1/1 to 12/31. So I guess I should clarify. So yes, it would be claimed on your taxes if you allow that distribution to go past 12/31. Do we have any indication of a possible December 2020 CARES Act component that will allow for 2021 mandatory required minimum distributions to be deferred? Chuck asks. No, currently we don't. So if you have a required minimum distribution coming in the next year, I would definitely look to say that that is something that is going to have to be taken. Let's see. Excuse me. Joel asks, if I took an RMD earlier in 2020 and have determined I can get by without the money, can I put the money back into the IRA and then pull out as my 2021 RMD? I would imagine yes. You are under the rollover rules extension for for the tax year of 2020. I would check with a tax advisor though, depending on when you took that out, if it was prior to the CARES Act being established, if that is still qualifying to be rolled back in. But if the distribution was taken after the CARES Act was signed and you would like to roll it back in, there's nothing stopping you. There's no different code to show a required minimum distribution as opposed to anything else. So yes, you could certainly do that. But again, 12/31 is when you would need to roll that back in to that plan by. Let's see. If I take the 401k under the CARE Act and I have 3 years to repay the taxes, do I have to divide in three total amounts, or can 10% the first year, 40% the second year, and the rest in the final year? Asked by Julian. So that's an interesting question. We don't have guidance on that yet. Essentially, what this individual is asking is that if they have the ability to break up their taxes over 3 years, which they do, but do they have to pay it in equal installments every single year? I don't know. I would imagine that is going to be an equal third each time, but again, the IRS is not necessarily giving guidance on that. So we do need to wait for a more clear stance from the IRS on that. Let's see. Following up my question, do I have to start paying taxes on the 2020 tax returns? Yes, you do have to start paying it on your 2020 returns if you took a distribution this year and it has gone into 2021 without rolling it back over. Let's see. I have tenants that are not paying the rent and have lease violations. Can I evict or give 7-day notice? With regard to that, I would strongly encourage you to contact a real estate attorney. Although there are provisions of the CARES Act moratoriums on evictions that are expiring, that is definitely something that is you need a strong legal opinion on with regard to everything that's going on in the world. I would not move forward with that, even if you have maybe done evictions in the past without getting an attorney on your side and getting some good legal advice. An hour of an attorney's time is going to be cheap insurance with something like that. Absolutely. So what is the deadline for the employee portions of a solo K contribution? Interesting question here. But the deadline for the employee contributions to a solo 401k are going to be on whenever the last payroll period is paid out. So that could be into January, but although you can make the employer contribution up until your filing date plus extensions for your corporation, I would say that no longer than the last pay check of the 2020 year. So if you pay out and your pay period falls into the first or second week of January for what covers up to the 31st of December, then that's when it would need to be paid out by. Can I suspend required minimum distribution payments if I continue to work as an employee beyond the age of 72? Unfortunately, no. You can continue to contribute to retirement plans if you are over the age of 72. You can continue to contribute to SEP IRAs or 401ks if you are participating in them, but you cannot defer required minimum distributions. The only thing that can defer a required minimum distribution is a Roth IRA because it does not have one. And that's about it. So I'll go ahead and end the presentation there. Again, this is a little bit shorter than we've had in the past, but again, I just wanted to bring you some important information for the end of the year for coronavirus relief and the CARES Act. Again, my name is Alex Perney. If you have any questions, please reach me at 727-754-9954, or I can be reached directly at aperney@advantaira.com. Thank you and have a wonderful day.